Millions of Americans use ATMs every single day without thinking twice about it. You walk into a convenience store, grab some cash, maybe pay a small fee, and move on with your day. Simple. But what if some of those fees weren't supposed to happen in the first place? What if tiny charges, just a few dollars at a time, quietly added up across thousands of transactions until they became the center of a legal battle involving one of the biggest banks in America and one of the largest convenience store chains in the country? That's exactly what happened in the Bank of America and 7-Eleven ATM settlement story, a case that exposed how small financial frictions can become massive business profits. To understand why this matters, you have to understand how ATM fees work in the United States. When a customer uses an out-of-network ATM, there are often two separate charges happening at the same time. The ATM owner may charge a surcharge for using the machine, and then the customer's own bank may add an additional out-of-network fee. Most people barely notice it because the amounts seem small, $3 here, $2 there. But for banks and ATM operators, those tiny fees generate enormous revenue streams every year. In fact, ATM fees across the US bring in billions annually, largely because convenience usually wins over caution. The issue behind the Bank of America and 7-Eleven settlement centered around claims that some customers were improperly charged fees during ATM withdrawals at certain 7-Eleven locations. According to allegations in the lawsuit, customers believed they were being charged unexpected or duplicate fees connected to ATM transactions involving Bank of America debit cards. Now, settlements like this are important because they don't always mean a company admitted wrongdoing. In many cases, large corporations settle disputes simply to avoid long legal battles, negative publicity, or the growing cost of litigation. But even without admitting guilt, the existence of a settlement raises uncomfortable questions about transparency in consumer banking. And this is where the story becomes bigger than just one lawsuit. Modern banking depends heavily on what economists sometimes call friction revenue. These are profits generated from small inconveniences, penalties or overlooked charges, ATM fees, overdraft fees, late payment penalties, foreign transaction fees. Individually, they seem harmless. Collectively, they create billions in income for financial institutions every year. The average customer rarely studies the fee structure buried deep inside account agreements, and banks know that. Most people focus on convenience, not the long-term math. There's also a psychological layer to this system. Consumers are far more sensitive to losing large amounts of money than losing small amounts repeatedly. A surprise $500 charge would trigger outrage instantly, but a $3 ATM fee, most people ignore it. That's what makes these systems so effective. Small financial leaks become invisible habits. Over time, those habits quietly drain money from checking accounts, especially for lower-income Americans who rely more heavily on cash access and out-of-network ATMs. What makes this even more interesting is the timing. In recent years, American consumers have become far more aware of hidden banking costs. Rising inflation, higher credit card interest rates, and economic uncertainty have pushed people to scrutinize their finances more carefully. Consumers today are paying closer attention to everything affecting their FICO scores, monthly budgets, and long-term savings goals. Even younger Americans building emergency funds or contributing to a 401k are starting to question how much money disappears through invisible financial systems designed around convenience fees. The Bank of America and 7-Eleven settlement is ultimately about more than ATM charges. It's about trust inside the financial system. Most people assume that when they interact with major institutions, the process is fair, transparent, and accurate. But stories like this remind us that even the smallest financial interactions can become complicated when massive corporations, payment networks, and consumer behavior collide. Because in modern finance, wealth isn't always transferred through giant dramatic transactions. Sometimes it moves quietly, a few dollars at a time, hidden inside routines so ordinary that nobody stops to question them until millions of people realize they've all been paying into the same system.